Hi guys, this is the debrief video for the first quiz that we had conducted, which is on IAS 37 and IAS 10. What I'll be doing right now is I'll take you through the question paper, which had basically 10 multiple choice questions, and I will tell you what the correct answer for each one of those is along with the explanation. So make sure that after you have solved the test, you do watch the video. Even after watching the video, if you have any questions, please let me know. More than happy to get on a call and clarify. Now, this quiz was on IAS 37 and IAS 10. Now, the first question, which of the following would require a provision for a liability to be created by CZ at its reporting date of 31st of August 2005? Now, when you say that you need to create a provision, there are four essential ingredients for creating a provision. What are those? Present obligation as a result of past obligating event, the settlement of which will lead to outflow of economic benefits, and it is probable that such outflow is going to happen. Point number four. Point number four is that a reliable estimate of the obligation can be made. If you observe this first question, the government introduced new laws on data protection which come into force on 1st of January 2006. My reporting date is 31st of August 2005. CZ's directors have agreed that this will require a large number of staff to be retrained. At 31st of October, the directors were waiting on a report they had commissioned that would identify the actual training requirements. While it is clear that the new law for data protection will come into force on 1st of Jan, on 31st of October, you have to see whether all the four conditions are getting fulfilled. Here, the directors are still waiting for the report on 31st of October. So you don't know exactly what the training requirements are going to be. Therefore, you don't know the amount of outflow for training requirement payment that would have to be made. So even if you are spending on a trainer, you don't know what all areas is he going to train the staff on, and you don't know how much money you have to pay him. So a reliable estimate of the obligation cannot be made. And that is why it is not possible for us to create a provision with respect to the first part. The second one, at the year end, CZ is negotiating with its insurance provider about an outstanding insurance claim. On 20th of November, the provider agreed to pay 2 lakh. A, this is CZ is negotiating with the provider. So basically, this is a claim that CZ is going to receive. This is not an item on the liability side. This is an item on the asset side. And on 31st of October, the negotiation was still on. The amount was finalized on 20th of November. So if at all anything is to happen, you will have to make a disclosure regarding the insurance claim receivable. So no requirement to create a provision. Look at number three. CZ makes refund to customers for any goods returned within 30 days of sale and has done so for many years. Uh, if it has done so for many years, that means it has created a valid expectation in the minds of the shareholders, in the minds of the customers, that if you return the goods within 30 days, the amount will be returned to you. So, first of all, it is very clear that a constructive obligation has been created in the minds of the a valid expectation has been created in the minds of the customers, which means there is a constructive obligation. If there is a constructive obligation, the entity knows ki if we make sale to 100 customers on the basis of past track records, how many customers return the goods and what would be the amount of refund that we have to pay. Which is why if you look at it, there is a present obligation. You have no realistic alternative apart from making the payment when the customers come to you. Point number two, uh, it has to happen because of a past obligating event. Now, the sale that happened in the past is the past obligating event, which is triggering the fact that yes, if a customer comes back to you, you will have to return the amount that he has paid. So there is a past obligating event, which is the sale. You don't have a realistic alternative apart from making the payment. It is probable that the settlement of this particular obligation will result in outflow of resources embodying economic benefits. In short, it is probable that you will have to pay cash in simple terms. And because a valid expectation has been created in the minds of customers, yes, it is very much possible, or it is very much probable that you will have to make payments to customers. And when you have to make payments, when you have to refund the amount to customers, You also know the exact amount, or if not the exact amount, you can make a solid estimate of the amount that you will have to refund. So all the four conditions have been fulfilled, which is why statement 3 would require a provision. A customer is suing CZ for damages alleged to have been caused by CZ's product. CZ is contesting the claim, and at 31st of October 2005, the directors have been advised by CZ's legal advisors that it is very unlikely to lose the case. See, if CZ is unlikely to lose the case, that means the chance of winning is more. Chance of winning is more means chance of winning is more than 50%. They have said it is very unlikely to lose the case. If it is very unlikely to lose the case, there is a very small probability that it would have to make the payment. And when the probability is less than 50%, then you don't create a provision. You basically should disclose a contingent liability. And if see, look at the word very unlikely. That means there is a very high chance that you will not have to make the payment. And that means if the probability of payment happens to be less than 5%, then you have to do nothing because that's a remote chance. So the answer to question 1 is option 3. I hope that's clear to everyone. Look at the second one. Using the requirements of IAS 10, events after the reporting period, which of the following would be classified as an adjusting event after the reporting period in financial statements for the year ended 31st of March? Directors approved the financials on 31st of August. Now, events after the reporting period are those which take place after the reporting date, but till the date the financial statements are approved by the directors. Now, in this case, they are talking about an adjusting event, which means the conditions for this particular event should have existed on the balance sheet date. A reorganization of the enterprise proposed by a director on 31st of Jan 2004 and agreed by the board on 10th of July. See, the reorganization was proposed, but in case of reorganization or in case of reconstruction, you know the provision, right? In case of a provision for reconstruction related expenses has to be made only if there is a constructive obligation on the balance sheet date. And a constructive obligation on the balance sheet date means you should first have approval of the board of directors, and this particular decision has to be communicated to the stakeholders by way of a press release or by way of a meeting or by way of any other form of a communication that has to reach the ultimate stakeholders. If it doesn't reach the ultimate stakeholders, that means there is no constructive obligation. Because there is no constructive obligation, statement 1 is not does not require the creation of a provision, which means the conditions did not exist on the balance sheet date. If at all you want to do anything, you should do a disclosure in the financial statements, not an adjusting event. You don't go back and make changes. A strike by the workforce which started on 1st of May and stopped all production for 10 weeks before being settled. The conditions for this event did not exist on the balance sheet date. Because the conditions for this event did not exist on the balance sheet date, there is no requirement or there is no need to go back to the financial statements and make any adjustment. So this is ruled out. Look at option number 3. The receipt of cash from a customer the receipt of cash from a claim on an insurance policy for damage caused by a fire in a warehouse on 1st of Jan 2004. 31st of March is the reporting date. Fire occurred on 1st of Jan. So that means it happened before the reporting date. The claim was made in Jan 2004 and the amount of the claim has not been recognized at 31st of March 2004 as it was uncertain. The insurance enterprise settled with a payment of 1.5 million on 1st of June 2004. The confirmation by the insurance company confirms a particular value, the conditions for which already existed on the balance sheet date. This is not a new event altogether. The trigger has already happened before 31st of March. Only the amount is getting confirmed after 31st of March, and insurance company has decided to grant you the claim after 31st of March. But the event occurred before 31st of March. So the fact that the insurance company has now approved the claim, given its approval, and it has agreed to process the payment, confirms a value on 31st of March. So this is an adjusting event. The event that takes place after the balance sheet date confirms a balance that was in existence on the balance sheet date. Hence, your answer should be option 3. Option 3 is an adjusting event. The enterprise had made large export sales to USA during the year. The year-end receivables included 2 million for amounts outstanding that were due to be paid in US dollars between 1st of April and 1st of July 2004. By the time these amounts were received, the exchange rate had moved in favor of the enterprise. Any fluctuation in foreign exchange rate is completely unequivocally a non-adjusting event because the conditions did not exist on balance sheet day. So again, answer to question 2 is option 3. S is preparing its financial statements for the year ended 30th September 2007. S is facing a number of legal claims from its customers with regards to a faulty product sold. The total amount being claimed is 3.5 million. S's lawyers say that the customers have an 80% chance of being successful. According to IAS 37, provisions, contingent liabilities, and contingent assets, what amount, if any, should be recognized in respect of the above in the statement of financial position? Now, first of all, it is crystal clear that the lawyers are saying that the customers have an 80% chance of being successful. If the customers are successful, you have to pay them. That means the chance of you, the probability of you, S Limited, having to pay is 80%, which is more than 50%. So it is probable that there will be an outflow of economic benefits. So what is the amount of provision you will create? You will create a provision for the entire 3.5 million. Your answer again is option 3. Okay. Question 1, question 2, question 3. For all three of them, the answer is option 3. Plutus has year end of 31st of December 2004. On 15th of December 2004, the directors publicly announced their decision to close an operating unit and make a number of employees redundant. Now, see, for you to make a provision for reconstruction, the obligation has to exist on the balance sheet date. What obligation? Constructive obligation. Simply the directors making a decision in the board of directors meeting is not enough. They have to announce it to the world. Only then the world at large will have that particular expectation in their minds for a constructive obligation to exist. Some of the employees currently working in the unit will be transferred to other operating units within Plutus. The estimated cost of the closure are redundancy cost 800, lease termination 200, relocation of continuing employees to new location 400, retraining of continuing employees. What is the provision that you should create? First of all, redundancy cost provision will be done. Lease termination cost. Plutus was operating out of a location. Now it is planning to shut down that location. So maybe the lease agreement contains a clause which says that if you terminate the lease agreement before the due date, then you will have to pay us a certain amount. That amount is 200. Please understand that this amount came into existence for what reason? This amount came into existence because of the reconstruction or closure. It otherwise you would not have incurred this cost. So this cost relates exclusively with the termination of the that particular line of business. So this cost will be included. But relocation of continuing employees to new locations, see, that can happen regardless. And retraining of continuing employees, while I can understand that retraining might happen because of the closure of a particular division, but retraining and relocation is something that can happen or that does happen even without the reconstruction or relocation. Employees can be transferred or usually are transferred even when there is no closure of a particular line of business. And retraining is something, which all organizations always have to continuously keep on doing. So the last two costs are not to be considered while calculating the closure provision. Only 1 and 2, 800 plus 200, that is 10 lakhs will be the amount of redundancy provision. See, it's important for you to understand which expense happened solely, exclusively, completely because of the act of closing down a particular unit. When you have closed down a particular unit, what costs got triggered by it? 1 and 2. If there is any other cost that happened, but it can get triggered because of any other reason also, retraining has to keep on happening. It's not that it is happening only because the unit is getting transferred. Normally bhi retraining of employees hota hai. So that cost is not associated with closure. But if in certain questions, very rare chances, If in certain questions they mention that specific fact, then your answer might differ. But here for now, your answer is option 2. Okay. Then on 1st of October 2003, Mike commenced drilling for an oil in an undersea field. The extraction of oil causes damage to the seabed, which has a restorative cost, ignoring discount, of $10,000 per million barrels of oil extracted. Mike extracted 250 million barrels of oil in the year ended 30th September 2004. Mike is also required to dismantle the drilling equipment at the end of its 5-year license. This has an estimated cost of 30 million on 30th September 2008. Mike's cost of capital is 8% per annum and $1 has a present value of 68 in 5 years time. So discounting factor for T5 is 0.68. Okay, that is what this means. What is the total provision which Mike would report in the financial statements for the year ended 31st of December 2004? Now, this is a peculiar question, and there are so many places, where a person can go wrong. Let's understand what those places are. I hope you can see the question. First of all, the data is given on 1st of October as they usually do, but they have asked you the provision you need to create on 30th of September, which means you have to be a little careful. The balance that they have asked you is the balance on 30th September. Now, first of all, the restorative cost of 10,000 per million barrels of oil extracted. So let's do this calculation in our Excel sheet. This is question number 5. Okay. So when you extract and provision, of course, all of you know what is wrong with this sheet. The font is not Times New Roman 11, and we know how difficult it gets for us to do it without this font. Cholo, you extract 1 barrel of oil, you extract 1 million barrels, rather 1 million barrels. How much is the provision for 1 million barrels? You have a provision of 10,000. So for 250 million barrels, the provision is naturally 10,000 into 250. Okay. This is the amount of provision that you would require for how many barrels? For a total of 250 million barrels. Now, this is not the entire question, by the way. This is just a part of the question. And apart from that, what do you need? Apart from that, you also need to talk about the dismantling provisions. Here they have said that there is a restorative cost and they have said ignore discounting. So please don't take that into consideration. Look at the question. They have specifically mentioned that it has a restorative cost of 10,000 per million barrels, and they have said ignore discounting. But look at the second part of the question. Mike is also required to dismantle the drilling equipment, and at the end of its 5-year license, this has an estimated cost of 30 million on 30th September 2008. Mike's cost of capital is 8% and 1 million has a present value of 68 cents in 5 years time. So present value of $1 is 0.68. This is T5. Usually we calculate, but here they have given it to us. The amount that you expect to pay is amount expected to be paid after 5 years is 30 million. Present value on 1st of October 2003 is this into 0.68. See, if they have given you a particular rate for discounting, then please use that number. Don't use any number of your own choice. Okay, so this is one part of the provision. This is present value of the provision. What is the So to this, I will add the discounting or unbinding of discount. So finance charges at the rate of 8%. This into 8%. So balance on 30th September 2004, 2203 2000. This is the balance as on balance of dismantling provision on 30th September 2004. And this amount is static. They have specifically said ignore discounting. So don't ignore discounting. Don't add the discounting element for no reason. So this amount will remain the same. So what is the total payable balance on 30th of September 2004? The total payable balance is this plus this, which is 24532,000, which, if I'm not mistaken, is option 2. Okay, so you just have to be a little careful. Specifically, just ignore the discounting part. There is a chance that you will get tempted to unwind the discount. You are not supposed to do that. And second place where you can go wrong is that they have asked you the balance on 30th September. You might end up just ignoring this part or आपका value गलत हो जाएगा. So be a little careful. If you have any questions, do let me know. Looking at the next one, which of the following events which occur after the reporting date of an entity but before the financial statements are authorized for issue are classified as adjusting events in accordance with IAS 10? ठीक है. Adjusting events, which means conditions existed on the balance sheet date which only got confirmed through an event which took place after the balance sheet date. A change in tax rate announced after the reporting date but affecting the current liability, current tax liability, the discovery of a fraud which has occurred during the year, the determination of the sale proceeds of an item of plant sold before the year, and the destruction of the factory by fire. Now, let's understand. See, an adjusting event is something the conditions for which already existed on the balance sheet date. They only got confirmed later, but the conditions already existed. If you have a closer look at this, see, destruction of a factory by fire after the balance sheet date, there was no way you would have known on 31st of uh, say on 31st of March, there was no way for you to know कि यार बाद में आग लगेगा. Had you known that, you wouldn't sit and अरे अभी आग लगेगा, अभी I will do an adjusting event. You will make all efforts to stop that from happening. You did not know on 31st of March. Question, so statement 4 is out. Determination of sale proceeds of an item of plant and machinery sold before the year end. Uh, See, if the determination of sale proceeds happens after the year end, you will have to evaluate whether all the conditions for sale, which basically, IFRS 15 wala conditions, whether those conditions were getting fulfilled before 31st of March. So that evaluation will be necessary. The question specifically says that the determination of sale proceeds happened later, but the plant was sold before the year end. So conditions already existed on the balance sheet date. This event just confirmed that value. So statement 3 is an adjusting event. Discovery of fraud is an adjusting event because fraud had already taken place. You only discovered that later. So statement 2 and 3 both are adjusting events. Destruction of a factory by fire, statement 4, and statement 1. Change in tax rate after the reporting date is not an adjusting event. Why? Because conditions did not exist on the balance sheet date. So answer is option 2. Now, each of the following events occurred after the reporting date, but before the financial statements were authorized for issue. Identify whether the events would represent adjusting or non-adjusting events. A public announcement in April of a formal plan to discontinue an operation which had been approved by the board in February 2005. Now, understand one thing, that if, see, the constructive obligation here, see, this, we are talking about a reconstruction situation, right? Discontinuing an operation. So when you have to create a provision, ideally for that there has to be a constructive obligation on the balance sheet date. If there is no constructive obligation on the balance sheet date, you cannot create a provision. Now, constructive obligation can only happen when you have made a public announcement of your plan and the stakeholders are aware of it. In this case, the public announcement was done after the financial year came to an end. Okay. So Because it happened after the financial year came to an end, the constructive obligation also got created after 31st of March. So you cannot go back because the conditions did not exist on the balance sheet date. See, only board approval or board meeting decision doesn't help. For you to create a provision, that means you are acknowledging the fact that amount has to be paid to the shareholders. For that to happen, the conditions which necessitate the payment, the conditions which trigger the provision, have to exist on the balance sheet date. The trigger is the constructive obligation. That constructive obligation came into existence after 31st of March. It did not exist on 31st of March. So it is a non-adjusting event. First one. And second one, settlement of an insurance claim for a loss sustained in December. The loss had already happened, only the settlement for the insurance claim happened later. So this is an adjusting event. So first one is non-adjusting, second one is adjusting. Cool. Now, in review of the provisions for year ended 31st of December 2005, Phase Assistant Accountant has suggested the following accounting treatments. Which of the suggested treatments is or are permitted by IFRS? A provision for one-third of the cost of replacing an oven lining, which requires replacing every 3 years for technical reasons, but was last replaced on 1st of April. This is like a provision for a future repair. Ki you will replace after 3 years, you have to replace the oven lining. So they are saying create a provision for one-third. Now, to create a provision, you need four ingredients. Present obligation as a result of past obligating event. It is probable that there will be outflow of economic benefits. And point number four, what is point number four? That a reliable estimate of the amount of provision can be made. Now think about it. In this case, although last replacement has happened on 1st of April 2004, the next one will happen on 31st of March 2007. So the company wants to divide the provision over 3 years. But understand, it is quite possible that the oven will be sold before that particular date. So there won't be a requirement to change the oven lining. So there is no present obligation. What is the present obligation? You have no realistic alternative apart from making the payment. It is quite possible that before 31st of March 2007, you end up replacing the oven. So there won't be a need to make the payment. You will land up in a position where you don't have to make the payment. So in that case, there is no present obligation, hence no provision. This is wrong what they have said. The partial reversal as a credit to the statement of profit or loss of the accumulated depreciation provision of an item because the estimate of its remaining useful life has been increased by 3 years. First of all, when there is a change in the estimated useful life, it is a change in estimate. So the impact of that change is prospective. It is not retrospective. So this treatment that they have told you, it's completely incorrect. And third one, providing 1 million for deferred tax at 25 million relating to a 4 million revaluation of property during March 2005, even though Faye has no intention of selling the property in the near future. Whenever there is a revaluation of non-current asset, there is an increase in the carrying amount of the non-current asset. So the difference between the carrying amount and the carrying amount and the tax base increases. When this difference increases, naturally to the extent of increase, you will have to create a provision. And that is why only statement 3 is correct. 1 and 2 are incorrect. Okay. Question 9, true or false? IAS 10 events after the reporting date covers the period from the reporting date to the AGM. Ideally, no. It covers the period from the reporting date to the date the financial statements are authorized for issue. That is, to the date the directors sign the financial statements. That date is different. Date of AGM is different. According to IAS 10, events after the reporting period, any non-adjusting event should be disclosed as a note to financial statements. Yes. Non-adjusting event has to be disclosed as a note to the financial statements. But please be careful. Only material non-adjusting events have to be disclosed, not all non-adjusting events. So any non-adjusting event should not be disclosed by way of a note. Only material non-adjusting event should be disclosed. So even statement 2 is false. That means you have to read it very, very carefully. And last one, which of the following statements are true? Future operating losses cannot be provided for. True, they have not yet occurred. Changes in provisions should be applied retrospectively, adjusting the prior year financial statements. Then third one, provisions should be accounted for prudently, reflecting the maximum possible value that could be paid out. And provisions should be discounted to present value if the effect of time value of money is material. Yes. Statement 4 is also correct. 1 is also correct, 4 is also correct. Let's look at 2. Changes in provision is a change in the accounting estimate, which means it has to be applied prospectively, not retrospectively. Earlier, I thought that 40 customers will come for a refund. Now I think only 30 customers will come for a refund. Change in estimate, prospective effect. And they should be accounted for prudently, reflecting the maximum amount. No, basically it could, the amount that you reflect in the financial statements should be the highest possible liability if it is, if there is only one outcome, or the expected value of the multiple outcomes if there are multiple events possible. So statement 2 is also incorrect. Only 1 and 4 are correct, which means your correct answer is option number. What is the correct option number? 1 and 4, these two are true. 2 and 3, these two are false.